Hey guys, welcome back to the Capital Mindset Show. Today we're going to be beginning a series, a watch list series of sorts, because I've actually been intending to do this as the market is downtrending, and I saw one of you requested in the Discord community, but as the market has been downtrending, I wanted to actually start a new series talking about stocks that I'd be interested in actually buying. If they make it into this series, by the way, I don't want you to think I am buying this. I will make a video if I do end up buying a stock, or I might mention it during the video that I'm buying that stock. Regardless, what I want to actually point or highlight is that these are companies that I'm interested in, and I'm going to be kind of exploring with you guys what are the prices that I'd be very interested in purchasing. Now, the first company that we're going to be talking about is 3M. So 3M was in the portfolio for a brief moment in time, and I didn't mean to trade it. I didn't mean to do it that way, but I wanted to kind of just redeploy the capital elsewhere, and I didn't think we were going to get the exciting price anytime soon. So in hindsight, it's actually was a good move because I eked out a little bit of profit. And then with 3M actually downtrending now to where it is today, I want to take another look at it and see, okay, would I re-add it to the position or the portfolio, and what price would I be very interested in buying it at, what scale? So another kind of question for you guys that I'll leave to the end of the video is a different series that I'm contemplating about doing, but stick to the end of the video and then you guys can comment down below as to what your thoughts on that series. So here we're going to begin with 3M's price action. The price action is sitting at about $129.84. It is up $1,941 since its initial marker here on the max portion. Now we're looking at the PE ratio, GAAP PE ratio of 13.52 today, and the dividend yield is sitting at 4.59. The reason why I have it on the max portion, I want to show everyone who probably wasn't in the market for that long, that this was a company that could do no wrong up until about 2018. That's when they reached their high. And then from there, they experienced a lot of turbulence to where they are today. Okay, so they actually, if you were buying them around here, you probably remember the excitement around the stock. So you're basically getting prices not seen since 2015 right now. So that is partly why a lot of dividend investors are very excited. A lot of dividend investors, they want to accumulate assets like 3M, Johnson & Johnson, and I don't blame them at all. These are fantastic businesses. And I said that blame word maybe incorrectly because I'm not actually trying to insinuate there's an ulterior point of conversation on this. I'm not going to say, oh, but. There's no but. These are fantastic businesses. Now, 3M is a manufacturing business, so we're actually going to take a look at some unique things in the financial statements when we get to that, which actually we're going to get to exactly right now. So this is the 10K. I want to take us over first to the income statement so I can show you guys the net sales. So net sales has been rising, so they actually improved upon that. Now, total operating expenses also has risen, but the operating income has also risen as well, but not by that much though. So 7.1 billion to 7.3 billion. So it does indicate that there might be a little bit of a margin pressure going on, but of course we're in an era of higher rising costs, higher production costs, and that's actually probably coming from the materials. Raw materials are rising in cost, and therefore for 3M, that's kind of what they're experiencing. However, they're probably going to manage it over a long period of time. Net income, you can see down at the bottom, excluding, of course, on a per share basis, it is rising nicely from 4.5 billion to 5.9 billion. On a EPS basis, it actually also has been rising, and I bet you it is also rising on top of that because of not share-based compensation, but the opposite, share repurchases. So there is some share-based compensation. We will see that. And let's take a look at the balance sheet right here. So cash and cash equivalents, all that's staying about the same. One thing I'm going to highlight to you is something unique about manufacturing companies that you're going to see is this inventory section is typically going to be split up into these three categories: finished goods, work in process goods, and raw materials and supplies. They're quite easy to kind of remember. You learn this in your managerial accounting course as well as your cost accounting course. So in one of those, you're going to hear or learn about these different topics. Now, finished goods is quite literally finished goods, goods that are ready to be sold. They're done. Work in process means just they're not ready yet, but they're going to be ready. Raw materials is raw materials. So pretty easy to remember what all those are. Taking a look down here at the long-term debt, you see long-term debt is actually declining. They are paying it back. Now, if you look at the short-term borrowings or a portion of long-term debt, so that is what is owed within the year. And all the short-term liabilities are all what's due within a year, by the way. But all that's, pretty standard. Nothing like, I'm looking for something to pop out. Nothing's really popping out. And I wouldn't expect anything to pop out because it's 3M, right? I have a preconceived notion that 3M is a fantastically run business. There is, however, one liability that we're going to discuss, which is the overhang of the lawsuit regarding the earbuds for 3M that's going on with some veterans. So I'm not going to make a statement whether it's correct or incorrect. I'm just going to say that as an investor, as a potential investor, you want to pay attention to that liability, whether or not that's going to actually harm the company in a drastic way. How much is the end payout going to be? Not just simply what the court initially says. Look at for example, we looked at this with Cardinal Health, with the master limited agreement that they made with or master settlement they made with many states over the opioid epidemic. And so after that kind of gets off its chest, the market kind of digests it, and then that uncertainty is gone. Right now, there's an uncertainty built in, just the nature of business. And for 3M, they kind of got to resolve it for the market to kind of go, okay, it's okay. And, that's what we kind of have to wait for. Now, on the cash flow statement or statement of cash flows, we are going to see a greater amount of CapEx. You can see that on the line item of purchase of property, plant, and equipment. So it's going to be obviously higher, manufacturing business, and they kind of match line-in-line cash flows with net income. So more or less, we're looking at something that's kind of in line, right? In line. All right. So with that being said, we're going to go over to the presentation. I think it's important that we look at the presentation despite it being the sales pitch of the business, but we're going to look at it regardless. So I'm going to take us all the way to the top. So you have this. You want to look at special items that they're trying to highlight to you. They're putting it at the front. I like that. I can appreciate that, but we're not going to look at it right now because it's not really anything big. Now, if we're going over to this port, more of the special items. So again, I'm liking that they put this at the front. Now, this is where they're kind of just going to highlight in a point list the 6 goals that they have. So growing faster than markets and economies we serve. So, okay, growing faster than GDP. That's basically what they're trying to say. And I think that is possible, especially in the West. If you're comparing to Western growth rates are not going to be very good. Advancing sustainability commitments, yeah, cool. And then all that, cool. All right, so this is where we're going to highlight some key points. Organic growth of 1.7%, that's excluding acquisitions. And it's actually including the impact from respirators come down. Obviously, respirators are going to come down for obvious reasons because we're kind of getting off that stuff. Anyways, adjusted operating margin, cool. Earnings per share, awesome. All right, so this is the pat on the back slide. Nothing really good to see. I mean, some of you might care, some of you might not care, but this is patting on the back slide. They only have one slide here that I can see because the next slide isn't that. But, when a company has a ton of these, I kind of tend to go, oh, okay, cool. But when they only have one, it's like, all right, cool. You told us what you need to tell us. All right, move on. All right, so kind of going over from this, they're kind of talking about the margins right here. You can see that the raw materials actually in terms of margins or operating margins contributed a negative 2.4% there. So that's what's kind of getting squeezed there. It's a decent drop. All right. So let's take a look at the operating free cash flow, about 0.7 billion, down 50% year on year. And then so if we can actually see why did that happen, they should probably tell us. You can see there Q1 year-over-year decline due to higher cash compensation and increasing CapEx for so cash flows are basically just down for growth CapEx reasons. So that's all well and good. Or they're actually front loading maybe the maintenance CapEx. So nothing crazy. You want to take a look at the full year. They're probably just paying off a lot of the cash flow right now for their bills. And then as the year progresses, they don't pay the same amount later. Okay, so actually, I want to go through the rest of the slide, business group performance. Okay, so they're going to break down the different groups. So safety and industrial. I want to actually just take a look quickly through the margins, transportation, electronics, healthcare. So pretty much everything's at the same. Okay, so this is the lowest one, 17.1, but it is faster growing than the other ones. This one is faster, I think the fastest. Yeah, so this one's the fastest. This one's the second fastest, but the operating margins are the lowest. Okay, so good to know. Let's see here, outlook. So we want to take a look at this outlook. Okay, yeah, not really anything crazy. So we're going to go over to the evaluation portion, and we're going to kind of settle once and for all, what is the price that we'd be interested in buying, or I'm interested in buying? And of course, you guys can comment down below what prices you're interested in buying. Okay, so right here on the valuation model, we're going to, I guess, type in MMM, pull the data forward, And there we should see it in any second now. Okay, so I'm going to pull you guys here to the side so you guys can see that. Strong buy forecast by analysts. Price target of $170.98, applying a 31.69% upside. Sentiment score below 1. If you want to calculate that price to believe ratio as a joke, you take the price divided by sentiment. There you go, price to believe ratio. All right, so looking at some other metrics, the Altman Z-score saying no indication of bankruptcy. The model's own scores saying no indication of bankruptcy there as well. Taking a look at the revenues, estimates are actually coming down below trend line. However, for the most part, it's a steady eddy up and to the right. Cash flows are also steady eddy up and to the right. Estimates are actually to rise drastically according to analysts. Shares outstanding are declining. Okay, so as we were talking about earlier. Now, if we're going to look, ignore that growth rate, by the way. That growth rate is not really the growth rate. So if we're going to look at this company from the perspective of how much can they actually grow going forward, there are several estimates I'm going to kind of be pulling forward. If we actually look at the buyback rate, I think they're going to continue to do some level of buybacks. Let's go over to the ratios to kind of gauge. I removed the noise, so we're only looking at the 5 years. Current ratio or liquidity ratios look pretty good. And then on the solvency ratios, they look pretty good, well managed. DuPont analysis looks pretty good. Only concern is margins are actually declining a little bit from 2017. Operating margin, same thing. Net profit margin actually is rising. So then ROE is pretty good. And then if we actually scroll down for ROA is also pretty good. And ROIC is pretty good. Earnings quality, great throughout the entire time period measured. So nothing that I wouldn't expect from 3M. Okay, so if we go back to the summary report, we're going to actually kind of pencil out some different growth rates. And I'm going to actually say that on a higher end, I think that they can achieve around a 15%. And that's on a higher end. And I'm going to put that with the lowest probability of happening. I saw that some individuals think that, for example, they can grow at 12% possible. And then historically, they've grown about 10.5%, so 10.4%. And it'll just put it in there. And then we can actually pencil out another lower, more pessimistic scenarios, and then we can see. So what I'm showing you here, don't get too excited yet, because right now we're not implying that much of a margin of safety, that the company is trading at interesting valuations relative to where it was before. When it got to the $200 range, it got to the point where the market was actually, or investors were pricing in higher levels of growth. And that is a little bit on a cautionary tale, okay? So I would actually kind of say that, remember, their goal is to beat the GDP growth. And GDP growth in the United States won't probably be that good, okay? And we've talked about this in greater detail in other videos, but it's going to probably revert back to the pessimistic trend line of growth, and the United States will be like another Japan. So in terms of actual margin of safety, I would actually like to build out a greater margin of safety, and you can kind of see where we're at now. We're basically pricing in that average trend line growth from 3M of about 10%. Now, this is something I do want to, highlight, that right now at these prices, it is interesting. Okay, it's interesting. I would actually say I would prefer maybe actually start a position here for me, and then kind of ease into it over time, expecting that I could or may not get better and better prices. Okay, and this is a company that could very much become a core holding, but we'll have to keep an eye on it. I'm going to keep an eye on it for sure. I think at the prices now, I'm kind of interested in it. I'm going to be honest, but I'm not really sold on it yet. Okay. So as I said, I'm going to end the video here and ask you guys a question. Okay. So I'm thinking about starting another type of series, and this one, it will depend. So I'm going to do a series, maybe like a 13F series, where I basically show the capital mindset portfolio. So this is different from my personal portfolio. My personal portfolio is under, my own name, and then capital mindset has a portfolio that I designated a certain amount, and I can, for this one, I'm actually contemplating showing the dollar amount, because it won't be tremendous, like that. But it's going to be probably starting out with maybe $100,000, and then I'm going to be adding about $10,000 to it each and every month, around there. Maybe more, maybe less. I give it to my discretion. There's no promises on that. It's just maybe for entertainment, and then maybe just to talk about different investments. But for the regards of capital mindset, it won't be under my name, just under the business's name. Okay, that of course I own, but you get the picture. So I might be doing that, maybe, depending on the reception, depending on what you guys think, or do you guys just like it how it is right now? I will be only doing it after I leave my current employment. Okay, I won't be doing it before then, but it's something I'm really considering after my current employment. And then as I make that transition to my new employer, I might actually end up doing that series. Okay, so just food for thought, just for you guys to just think about, and then you guys can let me know down in the comment section below. You guys can, message me in the common threads on Discord, and then we can go from there. Just hearing your feedback, and also there's no promise that I'm going to do it. I'm just thinking about doing it. Okay, so just keep that in mind. On that note, guys, thank you guys so much for watching, and I will see you guys on the next one. Bye.